Hey everyone, Jason Jacobi here with El Presidente himself, Mark Boyer. How are you today?
Doing great, Jason. Looking forward to the July. I mean, can you believe it? We're hitting July already. It's amazing how quickly this time has gone, and that we're already doing a mid-year outlook. So, anyway, been a good year.
Good. Yeah, it's been a really good year so far. I mean, obviously, besides the tech, the market going up the way it has. Obviously, we'll talk a little bit about that today. But finally, we got some good weather here in Southern California, and summer seems to be here. So it'll be good to kind of get through some investment themes we have planned today, and some economic themes that we're seeing around the world. So we're gonna use some charts we found helpful from Capital Group and kind of talk through Boyer Financial's view and approach to investing and financial planning through this. So you ready to dive in?
Yeah, let's dig in. Let's dig in. This will be good. There's good information in here. So excited to share it and talk about it more.
Good. All right. So first thing, it's been on everyone's mind for the past almost 2 years now. Inflation. We've talked a lot about that. So first thing we want to touch on is where we're at comparison to the rest of the world. Not the rest of the world, but some of the big kind of economic centers that we look and compare ourselves to. So obviously we've got the United Kingdom still seeing the highest levels of inflation over there. Obviously a lot more tied. Their energy services are a lot more tied to what's going on in Russia, Ukraine, importing of oil and gasoline. So we're seeing highest levels of inflation still over the United Kingdom, followed by the Eurozone, then the United States, then Japan. So it looks like our estimates continue to see these inflation numbers falling. But why don't you talk about a little bit what we're seeing here in comparison to a lot of the developing world out there?
Yeah, I mean, as the chart shows, I mean, inflation's been coming down as far as, does it feel like it, honestly? I mean, you go to the grocery store still, and there's certain parts of, of the inflation issue that hits our wallets really hard. All of it does, but some of it more, kind of out there than other parts of it. So, but the reality is the last few weeks here and months, it seems to be going in a lower kind of trajectory. So that's good news. And again, a lot of that has to do with the Fed funds, being increasing so much over the last year or so. Even here recently, I mean, the Powell just talked about. We've been talking about this on our closing bells and each week, but the idea is that we're on a pause right now, and but like even this week, he talked about possibly raising rates a couple more times, which we wouldn't be unexpected that they would do that already. But the good news is, I mean, if you sit back and look at the bigger picture, the good news is that it does seem to be fading around the world, really, and so that feels better and will feel better, and the markets really want to see that. We could get into specifics. I don't know if we want to do that now, but as far as a longer term plan, but I think we believe that they're going to be higher for longer. We've talked about that before, and I know we'll talk more about that, I'm sure.
Absolutely. Some good points you brought up there. We do expect inflation to continue to fall, but it is remaining stickier than previously expected, right? I mean, even again, and nobody's got a crystal ball. We don't know exactly what's going to go on. The labor market has been resiliently strong. Even like jobless claims again came out today, a lot lower
Today.
than we had
Yeah.
expected, and a lot lower from previous weeks. And it's quite surprising. We were talking about it a little bit earlier in your office, but that's affected kind of this trajectory. As you can see my mouse, I'm kind of hovering over just to prove a point here. So obviously, going back to March when we had our first interest rate hikes here, and then to kind of where we're at now, the trajectory used to seem like it was going to be like this, kind of heading into 2023, that we were going to start coming down here in the second half of this year, right? That's kind of everything that we've been seeing. But again, what we've always said, it was higher rates for longer. So as you can see, this trajectory has kind of started to slip upwards a little bit more, maybe 12 and a half basis points, another 125, 212s to be seen kind of here as we get through the year. Because again, the numbers, preliminary CPI came out today, actually. We'll get the full numbers tomorrow, but it was still 4 and change. So still quite a bit higher and stickier than we've been expecting. So you still thinking, next year, possibly, maybe even the year after, we'll start seeing some significant rate hikes?
Yeah, so I mean, I think the Fed, they've got this goal of 2%, and there's parts of that I understand, I get it, but frankly, we've been talking about this, is that I don't think 2% is anytime close. Um, Historically, if you look back 90 years or so, 100 years, inflation's averaged 4% a year. So it's not unusual to have a 4%, annual rate. So that's,
Yeah.
and I think, again, you're younger, you probably haven't seen it, but, my age, it goes back to the 70s and 80s, and, life still happened in the 70s and 80s. And the reality is, mortgage rates were 12.5%. It's my first in mid 80s. I mean, it was like, can you imagine? I mean,
Yeah.
your generation would be like flipping out if mortgage rates get to 12.5%, right? I mean, that's just like crazy to even think about, but that was very normal in the 70s and 80s. And, it caused some stagflation, 70s, but then, it worked its way through, and there's lots of reasons why. But point is that, I'm not surprised that inflation stays higher and or takes a while to get to their 2% mark. I guess my bigger concern is that they're so fixated on 2% that I'm just
Mm.
afraid if they continue to push them rates higher to get there, that something doesn't break. We already saw part of breaking this year with the banks, right? Earlier this year, again, and that's part of Powell talked about that this week. At least he's communicating in regards to the banking issue that we saw a couple months ago has yet to even play itself out. So that's why they're putting this pause on the rates, because there are some good signs, but also that banking, especially the regional bank deal, where we're hearing more and more small companies have harder time getting money from their regional and local banks. So, that's gonna, that may lead to more of that recessionary that we're talking about, going forward. So, anyways, there's certain things that
Yep.
are going to play out here in the next number of months that'll be really interesting to watch.
Absolutely. So obviously our thinking, right, just to reiterate, higher for longer interest rates. We don't see rate cuts
Yeah,
happening this year, barring some kind of major break in our financial system, right? That's kind of what we're seeing here,
yeah,
which most likely,
yeah,
to lead into our next slide here, a recession seems likely, correct? So, in recessions, it scares a lot of people. People that went through 2008, 2009, and then again, kind of COVID was kind of like a little sample size there. Pretty quick recession, and obviously the markets and the economy bounced back quite strongly after that. But just looking, everyone always goes back to 2008, 2009. Is this what's going to happen? We saw the banks fail this year, a couple banks, right? And people started thinking, oh, this seems very similar to 2008, 2009. But it's actually quite the contrary. So what this slide shows, and I think, and again, I want to get your thoughts on this. So, you look at 2008 and 2009 here, which is kind of gray shade. That's signals a recession here in this gray shade. You had a lot higher consumer debt at that point. That's what this dark blue line just insinuates, disposable income in comparison to debt that each household has. So there's a lot more household debt back in 2008, 2009, right? Obviously, with that's kind of the reason the subprime mortgage collapse, people didn't pay their mortgages, and that kind of just trickled down, floor fell out from underneath a lot of the banks, and they didn't really know what to do, and they'd kind of overplayed their hands. And then you had a lot of companies, they weren't as financially, I guess the word solvent, financially secure. Their balance sheets maybe weren't as ironclad as one had hoped, which again kind of spans back to why they instituted the new stress test for the big banks, which actually they did. As of today, the numbers came out. All the big 23 banks that participated passed with flying colors. And that was instituted because of 2008 and 2009, when they actually had a lot less cash on hand. There wasn't very much oversight. The banking system changed forever. So with that being said, so are we seeing something, maybe a flip flop of that now, like where debt is a lot lower per household? That's kind of what we're seeing, correct?
Yeah, I mean, I think that's what we're seeing in the, the unemployment numbers that you mentioned earlier. The consumers are really a lot stronger. I don't think anybody thought at this point in the year that the consumer would still be
Yeah.
doing what they're doing. But this chart actually might show why. I mean, the fact is, here's the reality. This has like been the most anticipated recession that I've ever, in my years,
Mhm.
has ever been a part of. And I mean by we've been talking about recession. That's been sort of the R word the last, especially after last year. The destruction that happened, in the markets. Where that was going to lead, COVID, all these things. We just had the last few couple of years here has been like sort of, there's been a lot of news and a lot of bad news. So recession has been out there for a long time. And the reality is because of that, you've got companies, this chart, I mean, you look at the interest coverage that companies have. I mean, and really even the mark with consumers, like everybody knows it's coming. And so they've been preparing. So it's like one of these situations where, the weather's getting bad and it's, still looks
Yeah.
really cloudy and it's going to rain, so you prepare way ahead of time. Like this has been like 6, 9, 10, 12 months coming. So
Yeah.
it could be different this time in that, and maybe softer in that the both, corporations and the consumers have already kind of done their due diligence ahead of time to prepare for this recession, right? That hasn't happened yet. So you got inventories are down. I mean, they've got their kind of their ships in order, and so that's a positive thing going forward. So all this say may if we hit a recession, maybe a shallow one if and when it happens. And it's really interesting. It's an interesting time. I've not seen it like this before. And,
Oh,
yeah.
absolutely. There's some good points you brought up there, just in terms of companies and even individuals. So kind of both sides of the coin there, like expecting it. We've been talking about it. We've been like, oh, by the second half of this year, we're going to be in a recession. And here we are going into the second half, and the numbers just aren't saying that yet. So it's quite interesting, like you
Yeah.
said.
Yeah.
But one thing that
We still got 6 months of
has
this
been
year. We'll
really
see the
surprising.
cycle on the back end.
Yeah, yeah, yeah. But one thing that I did think that was quite interesting, I don't think anybody expected to have the type of first half of the year that growth stocks have had. Specifically our big five stocks. I mean, you look at the FANGs, right? That's Facebook, Apple, Amazon, Netflix, Google. I'm not saying all those five names, but just in terms of the market breadth we've talked about hasn't been this year what we wanted it to be. A lot of the numbers seem too good to be true. S&P 500's having a really good year so far. Nasdaq's up over 30%, but we got to remember where it has come from, 37% down at its bottom last year. So we're not even back to the high points, quite far from it actually. So um, just looking, what do you think? Do you think growth stocks are going to be able to come back in the second half of the year? I mean, again, worst performing sectors last year, best performing sectors so far this year, and then vice versa. The energy sector, best performers last year, and has kind of lagged a little bit this year, especially utilities, financials. It's quite interesting conundrum, right?
Yeah, I think that you know the AI, artificial intelligence, the semiconductors. It's like you see this chart here, and it's like, wow, this very narrow range of companies have really been a big part of the percentage of increase in portfolios thus far. The Nasdaq, as we're seeing. And so we've been talking for a while here is that needs to spread out. We need to start seeing, and I like this chart because it shows you like, and why it's important, I think, to have active management, like what we do and what the managers we use is that, things just don't always stay the same. So you got to be on top of that. You got to have done your research. You got to know these companies inside and out. And so, because times change and momentum changes. And right now, momentum is clearly to the upside on the high multiple, the growth companies, but they were also down the biggest, obviously last year. So that's not unexpected. The question will be, will there be a big pullback in that? And I personally, I think if we stay shallow in this recession, we need pullbacks. We need short pullbacks. Are always healthy for the market, but some of these growth stocks, are longer term in the AI. that's a space that's working its way out. And I think there's still opportunities there. But again, for the health of the market long term, we definitely need more. We need the stocks to spread out a little bit and have more normal companies. What I say, brick and mortar kind of companies actually moving up too. And then again, historically, you have these moves, in certain sectors, but over time it usually works its way through and to a good average return, right? So it's kind of that diversification really important, but you got to stick with it and you got to be patient. So it's hard to fight the markets right now. In those so if you're aggressive and look for those places on pullbacks, maybe to add some to a growth part of your portfolio if you have a long time frame. But a lot of our clients, a lot of people out there, my age, you don't have that long, you may not have that long time frame to weather situations if you're already retired or living off income. So again, I think that's where we get back to the dividend paying stocks. Those are areas long term where we really think that those places, multinational companies that are paying dividends, and that dividend section is really good too. So it depends on where a person is in their kind of their life cycle, and what they want to do with their portfolio.
Absolutely. And a few sectors, if you wouldn't mind kind of talking about some things that are themes that we're seeing, some sectors that we're liking, obviously healthcare, utilities, industrials, perhaps, or materials, basically leading to improved infrastructure, right? That's kind of been a big money maker just in terms of a lot of capital is kind of going into increasing and improving infrastructure here and abroad. So are there some of the areas that we're looking and focusing on?
Yeah, I mean, utilities, defense stocks, things like that, dividend payers, still like those. We've been talking about that a while. It hasn't, for most portfolios that are focused on that, it hasn't panned out as it haven't been as high flying. But again, longer term, dividends make a big part of a portfolio. So, I think you got to stick with it. And again, have money in different areas to take advantage of it. But, we still think that those stocks now, this time of year, when you're halfway through the year, it's a great time to reevaluate in those areas that have not looked so good. I'm looking at utilities. I mean, they've done nothing. I mean, but they're still like cash cows, a lot of them, especially there's just a lot of infrastructure companies, those big utility companies that, especially as renewable energy, things like this that are, still out there, they're going to have to make these changes and they're not going anywhere. So it's like, it'll be a time here where all of a sudden that they're going to be a move and those stocks are going to move up. So, again, you want to be in ahead of everybody else. So utilities, you think defense, infrastructure, like you talked about, all very positive areas. And the other one is, international. We've talked about this for a while, but the graph now is, let's talk about the dollar a little bit and international stocks, but I feel like international has a real stocks outside of the U.S. So, that's an area that people get really afraid of. Like, oh, I don't want to own companies in, other countries. And I get it. I mean, because, we're Americans, we want to buy and own American companies. But at the same time, if we limit your investment horizon to just U.S. companies, you're missing out on some really great companies that are outside the U.S. Okay, so, and it's interesting, based on this graph, you can see that even great global champions in Europe in this situation have exposure to the U.S. I mean, it's kind of crazy. Like, you look at this chart, and you're looking at these incredible companies, and I'll let you go through them, but they all have allocation to markets also around the world, like we're talking about U.S. companies do. So it's interesting, and those are good opportunities, and a lot of them have much lower PE ratios currently, and
Yes.
due to the dollar, could be great opportunities for the rest of this year and beyond, really.
Absolutely. Could not agree more. I think that's very key in looking. And again, a lot of people are scared to touch companies outside the US, whether it be India, Taiwan, other countries in Southeast Asia, even China, right? Because it's a communist government. And obviously the state kind of controls what goes on there. but still some great companies there as well. And then you got European companies, um, Latin America, even Africa and the Middle East have some kind of up and coming companies as well. So I think people need to kind of remember. So that's what you were talking about. This chart is just because they are based, whether it's Novo Nordisk, who makes Ozempic, which is kind of the miracle weight loss drug right now, almost half of their revenue comes from the United States. So you may be investing in that company, but that money is actually coming straight from America as well. A lot of their revenue stream. And obviously Nestle, you got Nestle, cocoa, water. I mean, they're such a diversified brand. They're based in Switzerland. Airbus, right? Airbus airplanes, very, very popular all over the world. And there was actually really large, there's been lately, the last year or so, even more recently, the last 6 months, there's been large orders of aircraft from a lot of different airlines, from budget all the way up to the main carriers, of tens of thousands of airplanes. So again, Airbus, great company. LVMH, which is like kind of they own a lot of luxury, ultra luxury brands, which have performed really well. Louis Vuitton, a lot of these luxury brands are up over 30% year to date, with their stock. And then ASML, obviously based in the Netherlands, but look at most of their profits comes from where? In the Asia Pacific region. So got to remember, and again, you tied it back to the US dollar being diversified. Like it's great to own the Apples, the Amazons, the Googles, Netflix, Nvidia. Like there are places in the portfolio for that. But also remember, hey, when they start trading at such high PE multiples, and remember, the higher the PE multiple, the kind of more expensive the stock is. There are companies, great companies like the ones we're showing here, that actually have lower PE multiples, and makes it a lot more advantageous. You're buying in basically at a better price to earnings ratio, cheaper price. So great points that you brought up. And then with the US dollar, converting it from international currency to the dollar, if it's a weaker dollar, it kind of juices and helps those returns even more so.
Yeah, I mean, yeah, and that's been a headwind to international investing, is the strong dollar. But as you see in this chart here, there are times where, or many times, in fact, where U.S. investing versus international investing, where international investing outperforms U.S. And the question is, especially, that hasn't been true for the last 10, 12 years. I mean, the dollar has strengthened. U.S. has been, economy, really on a roll for a lot of it. So anyway, you look at it, the dollar has kind of been it still is the currency of the world, but there's just times in where there's strength and then there's weakness. So there's a lot of debate right now where the dollar is going. The reality, though, if it goes weaker, which it looks like, from the chart, you can see it's been in this upward trajectory. If we start to pull back some, and we'll see what happens there. But, if it does drop, you'll see where when that's happened in the past, where, to our point, is that at that time is these other markets, these international outside the U.S. markets have really outperformed pretty substantially. So, and
Mm-hmm.
because of that, we don't know. We've been talking about this for a while, but the fact is there'll be a time where we think that definitely will have a period of time where international. So we're just saying, hey, pick your spots or whatever, figure it out. But that's, it makes sense for us with our clients to have, picking some good investments overseas.
Absolutely, absolutely. Now I want to go back again to dividends. You had mentioned it, I think 2 slides ago now, and how that kind of plays a big part in a portfolio. I believe in the last decade or so, the dividends haven't accounted for as much of total return of, let's say, of the S&P 500 as in the past, right? Because obviously those big tech, those growth companies have really just, again, with the low inflationary environment, low interest rates, low global growth, it was a very kind of a prime to the igniter, even more so, right? I mean, it kind of exploded. But we see that trend starting to return, right? Where we think dividend opportunities are going to be a larger part of the total return of a portfolio now than they have in the past, just with higher for longer rates. And then, but also companies that maybe have a little bit more cash on hand, that are They're paying out dividends that are growing their dividends. So talk to me a little bit about that and kind of our core philosophy, our core theme here moving forward and what we're looking at.
Yeah, so we've been in this period of really easy money for since '08, basically, where they forced interest rates low in order to stimulate economy coming out of that, the housing debacle in the mid '80s or '08 area, and so with that, the fact is dividends probably became less important because it wasn't easy money. Just you're all about growth. And so now with interest rates, now where they are coming back up and probably going to stay here for a while, we just think that dividends are going to be a big part of, and you're seeing that even 2022, where, you know, global companies paid out over $2 trillion in dividends. I mean, that's a lot of money, right? And again, let's explain what a dividend is. So if you buy a stock with a, 5% dividend, whether the stock appreciates in value or the stock price goes up or down, probably quarterly, semi-annually or whatever. If it's at 5%, they're gonna pay you. They're gonna share the profits of that company with you over the course of that year. So you get dollars that come into your account. You either take them as cash or you can reinvest them possibly in more of the shares of the stock. But it's a cash flow, And again, with that's a huge benefit because not only can you get appreciation of value if you buy the stock at a right price, plus on top of that you're getting income flow, which is has been significantly better than local banks and so forth. So anyway, I think that's dividends again long term have always been a significant part of the appreciation of portfolios and of stocks, and I think it's really important. And we've gotten away from it, but we think we're headed into a time where they're going to be again increasingly important. So that's why we like the dividend payers.
And that's true. And obviously with our clients, everyone's different. Everyone's got different situations, but having a sliver or a sleeve, depending on your goals, your income needs, whatever it may be, it's always good to have some kind of, whether it's reinvested or the spigot's turned on for that income, to have a sleeve of dividend payers, dividend growers, to kind of round out the portfolio, or at least have a core holding of it. So as you can see in this chart, dividends are going to play a significant portion of our estimated return and our compound annual growth rate. So we're looking at the next, previous 3 years, and the next 2 years from 2020 to 2025, implied, growth rate for the European index, the MSCI Europe index, is going to be basically 8.7% dividend growth, and then 5.9% for the US, and then Japan 9.4, which I want to talk about Japan for a second because they've actually done really well. Their economy has done pretty darn well recently. They've kept inflation really low, unemployment's low. Again, growth rates have been healthy. So it seems like there's some pretty good opportunities for investment, and maybe the U.S. can learn some lessons along the way with money management.
Yeah, Japan struggled for a long time, so it's good to see them finally starting to come out of that, maybe with some good decisions. And I think, as that happens, as their economy picks up, again, smart corporations will, start to share the profits with shareholders, and that's always a huge benefit for not only a stock market, but also for the economy itself. Because again, you almost feel like when you're getting dividends back, or they're sharing the profits. I mean, you're in it together now. So it's like it's it's like I like it. You're sharing profits back with us as the shareholders. We're taking on risk to own the stock. It's a way for them to really give money back, and I think it's long term. It's a really good deal. So I like that. Yeah, as well as Japan. That looks good.
Yep. Absolutely. So now let's move over to the bond side of the coin here. Obviously, everyone talks about money market, putting your money to work, just invest in money market or CDs or short-term treasuries, short-term bonds, but actually, at this point of the game, at this point of rate hikes, where we're almost done, supposedly. Um, our theme and what we've been talking to a lot of investment managers and professionals about has been going up and out in quality and duration, correct? That's kind of something we've been talking about. So why don't you kind of touch on, and again, I think your wisdom just have been through different markets. You went through the extreme inflationary environment of 70s, early 80s, and just talk about kind of where the corporate bond, the investment grade corporate bonds are, and what a pause or even rate cuts over the next few years could mean for the bond market, specifically corporate bonds.
Yeah, so I mean, I think bonds. So we've been in a 40-year cycle of lower interest rates. You go back to the 70s, basically, when interest rates were very, very high, and bonds, and so yields were super high. They were just elevated, and we've had 40 years of decreasing interest rates over that period of time, to the point that over the last 10 years or so, it's been, like we said, forced, where you get nothing. You got nothing in the bank. You get no yields in money market funds. And so that's another reason why I think, going back to the stock, there was a lot of reason is that dividends, stocks became more attractive because people were just looking for ways to get some kind of yield somewhere. But we mentioned this on an earlier podcast, that when you and I have sat down with bond managers recently, it's been so hilarious because these people are normally, don't have a ton of personality. They're very, mathematicians and
Number.
all. Not that I'm just saying, they're just very, um, you know,
Nope.
um, pretty mellow people. I finally, I'm seeing them smile and get giddy about interest rates, because now interest rates are back up and it's actually fun. There's yields involved. And you can see from this chart, look at, I mean, from 2019, 2021, where we're seeing some lows, to, we just, yields are back up. So, that makes it really attractive for bonds in a portfolio. And again, it's another place for us to get yields and in income on a regular basis. Bonds have been traditionally, they're pretty boring, probably like the bond managers or whatever we were talking about, but at the same time, they have been very steady for us longer term, until last year, when actually it was the first time in a long, long time where both stocks and bonds not only got hit, but got hit pretty significantly. And so bonds have yet to really, they've come back a little bit as far as principal values, but finally, though, the 60-40 kind of portfolio, or the balanced portfolio, is looking more attractive with bonds where they are with corporates. And, across the spectrum, from some low, for the shorter term bonds to the longer, higher yield, it's much more attractive. So the problem is, though, is that most people are still in cash. And I think with this, what I like about this chart right here is that it shows typically when bonds get back above, that 3.8, sort of that 5% yield. Traditionally, they have returns over the next couple of years of 6.5, to the mid 6% returns over that period of time, which is pretty solid. We haven't had that in the fixed income in a long time. So there's no
Yeah,
guarantees there, but that's historically how it's worked. So good. It's good news for bond investors.
absolutely, absolutely. That's a good point. And even going back to this chart real quick, you're getting yield to worst. So this is the lowest possible yield that can be received on a bond, that fully operates within the terms of its contract without defaulting. So this is measuring like the yield to worst percentage on these corporate bonds. So like you had said, anything above that 3.8% here, average forward year over year return over 2 years, 6.5% and 6.6. Now, I mean, we've seen charts and we've done some research on, if let's say the Fed starts cutting rates at some point, the next Fed meeting, boom, it's like, oh, something broke. We got to cut at 50 basis points. Those intermediate term corporate bonds, those investment grade bonds are really going to shine over the next few years. So that'll be interesting to watch when we actually pause and hold and start to descend, and become a disinflationary environment that could really, these things could really amplify above what we're seeing here. But again, something we're monitoring and looking forward to over the next few years. So
Yeah, and so, but if I could add something in there, I think that the biggest threat right now for bondholders, especially in the last here this year, is that right now it's still working, but the short-term bonds are, we got this inverted yield curve where we're getting higher interest rates on shorter-term fixed income. Um, at some point, especially later, that's going to change, and so uh, where you're going to get, like you just said, if we get some good news, and eventually the longer term bond, the market's still saying, hey, yields are still going to stay higher, and they may go slightly
mhm.
higher. So we haven't gotten much there, but at some point that'll change. And the negative to that is if you're still in the short term bond area, getting good yields, you can miss on a lot of appreciation and yields in a longer duration. So, really encourage people to be thinking like now. We'd even probably recommend that over the rest of this year, that you sort of dollar cost averaging. If you've got cash on the sidelines, if you've got cash in short term type yielding securities, this would be a good time to begin kind of lengthening your duration in bits and pieces, so that you don't miss out when that happens. Because that's the threat at the moment, is staying short term fixed income when longer term is going to really appreciate down the road here. But we'll see how that plays out. But I think that's one good strategy right now is the dollar cost average, kind of that barbell side, idea where you got your short term and then
Yeah,
maybe barbell, you start to build that longer term. Right now, everybody, I don't know if we're going to show that chart, but right now everybody's in cash,
yeah,
1.5 trillion or
yeah.
something, like, it's a lot of money. So, and so eventually that'll come work its way back. So anyway, just thoughts there.
Yeah. And in terms of the bond market switching from investment grade bonds, corporate bonds, to kind of the more risky bonds, the high yield bonds, the junk bonds, right? There's, I think, a lot of fear in that. Obviously, in the short term, when maybe not the best place to put it, with default rates, chances increasing just with a potential recession, right? These junk bonds are, again, a little bit more volatile and risky, but they spit off a higher yield on them. So as you can see on the chart that we have on the screen here, but is there anything you'd like to say on the high yield? Obviously, if you got a long time frame, now might be not a bad time to add a little bit to the portfolio.
Yeah, I mean, so high yields for certain people, again, time frame, what those types of things, whatever. I think that just know that the reason they're called high yield or the junk bonds is because they're just lower rated, meaning that if there's an issue with the entity that's issuing the bonds, there's some type of risk associated with default, and so there's a higher risk of default. Because of that, then investors require a higher yield in order to do that. So default rates have been relatively low, and but they've been, there's a little higher with the banking, companies, different things that have happened here recently. So that's caused some concern. But yeah, I mean, again, this chart, the eye in the sky doesn't lie. I mean, this is a way of looking at something and saying, hey, these rates, it can be a pretty attractive place to be here at this time. But again, it doesn't come without risk, and you just got to have a well balanced and diversified portfolio in the high yield space.
Good point. So we just talked about cash. We talked about how much money
Yeah.
is in money market funds, is going to flow its way back through the bond market into the stock market at some point once things kind of become a little bit more clear. So really interesting, right? So we've got, at this point, as of the end of May 31st, about $5.42 trillion in money market accounts. $5.4 trillion. That's crazy. That's crazy.
Well, that's what we were talking about. I think I said, I mean, if I said 1.5, I'm sorry. Maybe I said that earlier. I was like, I don't know. But anyway, yeah, the $5.4 trillion in cash is just what I was talking about. You have that much money in cash. And again, it goes back to our earlier points about why maybe the consumer's in better shape, or, corporations, is why this whole recession thing has been out there. people have put a lot of money on the sidelines and they feel safe there. And so thus maybe they're
Yep.
more willing to, as long as their job is fairly secure or whatever, that, that they can spend money. And so they're doing so, especially coming out of COVID. They're going on trips. They're doing, there's lots of things that people are doing. So that this could be a reason why at that point. So, but what happens here is, and again, why is the cash all there? Well, the cash is there because of fear. Mostly, I mean, a fear of recession, fear of a market last year that was down, over 20+%. We were in a serious bear market, Now, the interesting thing is that you get into this year and we've really come off the bottoms pretty high. And so if things sort of mellow out in here as far as inflation and the Fed, feels, they don't overdo it, you might have a shallow recession and the markets could keep going higher, and or bonds, right? We were just talking about that, higher yields. You'll see
Yeah.
movement. People will start like, oh, now you got the fear of missing out, FOMO. And so you start coming back into the market, and that feeds the next kind of the next bull. And that's what we're at right now, is like this, to have a real opportunity. There's a real potential opportunity here that all this cash on the sidelines is the fuel for the next uptrend for a while, right? So that's kind of key. And so anyway, and you can see that. I mean, it talks about that when you have this type of returns from in the S&P 500 peak to peak cash to the what the market does, S&P does over that period of time. That's not even talking about what the bond market. Probably see this. They have some money chasing stocks if it keeps going up. But again, back to what I just made the point earlier, you're probably going to see more with this cash, especially if short-term rates come down and this starts to be less inverted and kind of get to a traditional yield curve. You'll see more money going to longer duration, and again, to my point, that'll push prices up. And so that's what we're talking about. You'll be late to the party if you haven't already started going that direction. So cash is great. It feels good, but it's not always the best decision long term for a portfolio. In fact, many times not. And most times, consumers are going to be wrong on
Yep.
that, and they'll be playing catch up. It's kind of like being down, 14. Your team, the other team scores 14, unanswered points, and you're running out of time, and you feel like you got to, start throwing bombs, right? And that's what happens, especially as markets start to feed in. So anyway, just think wise decision, wise investment is to make those moves when it doesn't feel so good right now, and that's what we would recommend with cash on the sidelines for sure.
Definitely. And a lot of people, again, can become emotional and short-sighted. Like, hey, I'm getting 4, 5, 6% in a money market fund. The stock market's doing bad. My stocks are doing horrible, or even my longer term bonds are even not performing very well at this point, right? Because everything in an increasing rate environment, those longer term duration bonds are, they're having more price volatility at that point, or larger price volatility. So, it's easy to see the short term, like you were talking about, but when you realize, like, look, again, the proof's in the pudding right here. Like you said, the eye in the sky don't lie. I mean, within 3 months or 6 months after an S&P 500 trough, whether it be 09, 2020, probably even last year at some point at its lows, looking 3 and 6 months out, obviously it was higher. We come back quite a bit. I mean, 40% returns over 3 month in 09 to 55% return over 6 month. In the same pandemic, we remember that. I mean, we had the quickest, fastest market collapse, I think, since the Great Depression. And the returns, we had like 2-3 years of straight up after that, especially tech. I think you were up almost 300% at the highs for the NASDAQ, those tech stocks. So all my point is, hey, I know it's easy to see what's right in front of you. Lots of yield for basically virtually no risk. But also remembering, hey, what's my goals? Are my short term? Am I long term? How does this piece together in my overall portfolio? Really need to remember that. And that's kind of what we're here to help decipher and talk with our clients through.
Yeah. And remember, like, I think it's really important to remember not to follow the crowd in investing. A lot of times where the crowd's going is not probably the best place to go, because it's
Yep.
already over. I mean, in other words, any great investment idea, is not a great investment idea if everybody's already there, right? I mean, you gotta find the the gem that's out there hidden and whatever. So that chart you just showed, when you have that much money on the sidelines and the crowd is fully in cash, boy, it's time to be looking for where the next opportunities are, because that's where they'll all be flowing next, and that benefits you if you're early in. So that's all the point. It doesn't, so it does feel good to have, getting 4, 5, 6% in, T bills, or short term T's, whatever, 5%. And yet, man, you'll miss out on, like we showed you already, you'll miss out on the 10-12% types of returns over your, by just
Yeah.
by waiting. So anyway, just don't follow the crowd, and where the crowd, they're always late to the party. So get there early. That's really wise investing. I mean, Warren Buffett has made a name for being that guy who doesn't follow everybody else, who buys when everybody's panicking and selling when everybody's giddy, right? So it's just that's just smart investing.
Absolutely. And this chart, again, is proof in the pudding right here. I mean, you look at, average returns following the last Fed rate hike. And again, we don't know when that is. Again, nobody's got a crystal ball. They can make that choice and then release that news to the public, and then the markets are going to react based off of that, right? I mean, they could come out and say, oh, we're not going to hike rates. We're going to pause for the time being. And they come out and they raise rates again, or they decided to cut rates for some reason. Whatever it may be, again, that's the thing, is we can't control. What we can control is our emotions. We can control uh, how we're invested. Uh, and again, keeping our financial goals and our financial plans in order and sticking with those, doing the little things right we talk about on our podcast, Move the Chains. I think that's really, really key. And again, the proof's in the pudding right here. So if you're waiting for that rate hike to stop, or wait for those rate cuts to come into picture, and they start cutting rates, you're going to be late to the party, like Mark, like you had just said. Because obviously U.S. equities, even a 60-40 portfolio that got hammered last year, that prevented a lot of people from retiring because of the extreme rate hike campaign that took place. U.S. bonds, international equities, short-term bonds, they all perform pretty darn well, over the next year following the uh, the last rate hike. So this is a really good chart for people to look at.
Yeah, that's a great chart, and I mean, um, again, all of this has to do with kind of where you are in your life cycle as far as investing, and again, you can't live your life in fear. If the fear indexes have been incredibly high, um, and that forces people to cash, because that's the natural thing to do. Um, I'm not saying there's not things to be afraid of. There's always a reason not to invest, pretty much. But you'll see longer term, that it's important to remember what part of your portfolio is short term, and what amount of your portfolio, and looking at your whole portfolio, well, how much of it is midterm, 5 years out, and then how much of it is 10 years out. And again, if it's 10 years plus out, if you got those even 5, 7 years, and you got that time frame, you should never be afraid. You should be adding. I mean, you should be putting money in when the markets are lower and everybody's just freaking out and going low, because that's where the money's made, is in dollar cost averaging at those times. I mean, we could show you chart after chart, and we could talk about that forever. But again, it's looking at your specific situation, you know, uh, over a course of what you're trying to accomplish and where you're going will determine where you have your money. So this just shows that, again, cash is great. You need cash. I mean, 3 to 6 months of living. We talk about that all the time. And then, or there might be something you're getting ready to, you're saving for, whatever. Cash is great, and it's great to now have cash where you can get a yield. But if it's longer term
Absolutely.
investing and you need it to grow and outpace inflation, and you got to get it into the markets, you do. You just have to. And if you're scared about putting it in, because every time you got bad luck, every time I put it in, the market goes down. Well, first of all, that's again, it's another fear tactic. But the reality is that's probably not true. But even if it is, then dollar cost average. Put in 25% now, and then 25% in a month. Do it a different way, or you don't have to do it all at once. So, but just make sure you do it, and you have a well balanced portfolio along the way, and stick with it.
Well, I love it. That's some great closing advice there. This is the last slide of the mid-year outlook that we kind of wanted to cover at this point. But anything else that you want to throw in? I know obviously we just want to thank all of our clients first and foremost for trusting us. I know it was a tough 2022 and a volatile 2023 so far, but we really appreciate you just placing your trust in us. We do our best to serve you and think of your money as our own when we're trying to help you decipher and make decisions and plan for your futures. So I think that's all I've got.
Yeah, and I agree. I love our clients. It's fun. I love helping people. I've told this before. My background in sports, professional athlete, the whole bit. I mean, I could have easily gone into coaching, but I wanted to know my kids, and I love my wife. I didn't want to be home. I didn't want to be coaching 24/7. So this was an area. I've been involved in ministry activity, different stuff, and lots of great things. But I don't, I love helping people reach their potential. And this is one way, and money is a big part of that. I mean, money's you get into money issues, you get into intimate conversations with people because, spouse, I mean, how many times we meet with spouses and, it's a challenge because one spouse super aggressive, the other one's super conservative. And so you're playing almost marriage counselor doing that. So I love this job. I love that. I love the opportunity to do that and help people reach their financial goals. And so, so thanks for that. And again, if you know somebody else, I would just say this, if you or somebody else needs more help in that area, feel free. We'd love to, we're always wanting to help other people. So if you got referrals or anything like that, send them our way. We want to help more people reach their full potential in life, and also which includes money and those areas too. But yeah, great stuff. Really fun. Enjoy it. Thanks for your time, Jason. You're doing a great job too, and I like it is that we get to be sort of a elder. I'm an old guy, and you're sort of in that middle generation. It's really, really important. And I love that I love the doing that together with you because we're in different places. So it's good.
Likewise, Mark. It's an absolute pleasure working with you and learning from you. And obviously, you've been through a lot of different market cycles. And I'm not saying you're old, but the wisdom is definitely there. And it's super fun. We have a good time with it. But thanks for everything you do as well.
There's a verse in the Bible that says a man with white hair is a man of wisdom. So I like that verse. It's one of my favorites.
There you go. Scripture is God breathed, right? So there you go. I mean, it's straight from the big man. All right. Well, a couple of quick reminders for everyone out there, whether clients or not, just some things to think about as we move through the next 6 months. A lot of times summer is a time to relax and sit back and go on vacations, which is great. You should be spending time with your family, your friends, and taking some time to decompress after the first 6 months of the year and all that. But some things to think about: tax planning in the summer. Not a lot of people think about it. Think about your estimated taxes. Maybe even start looking at last year's tax returns to kind of see what changes do you want to make for next year. Look for deductions. Look for opportunities to maybe lessen the tax burden. Nobody likes paying the man. And then also cash flow planning. Do you need to make any changes for the next 6 months? Do we need to increase, decrease income, withhold more or less tax? And then also planning for 2024 year-end distributions, RMDs, maybe even changing the percentage of income that you're taking from your portfolios, wherever they may be. So again, some things to think about on the tax planning side. And again, as Mark said, if you or anybody else needs assistance in financial planning, investing, insurance, whatever it may be, we're here for you. But Mark, any last words for us before we go?
Yeah, I would even say I've been thinking a lot, Jason, recently about topics for for us going forward. And you mentioned all those areas for taxes, and I love that. And I don't think you do this one for taxes either, but I'd like to talk about giving at some point. I think that I
Yeah.
think it's an important topic for us to discuss with our clients and so forth. I mean, I found in my life, my wife and I, that giving to our church, to to help ministry opportunities, stuff like just nonprofit giving of our abundance, and even out of that, there's a lot of joy in that. And so you get a tax write-off, but also encouraging, like there's just it's great to be able to give, and we've been given so much. It's great to give back. So I think maybe let's do a podcast sometime talking more about that area. But you speak about taxes. I think that's a great way. It's a great write-off, but also it's also awfully fun to be givers too, rather than receivers all the time.
Absolutely. Definitely echo that sentiment and statement. So that's the end of this year's mid-year outlook. Call, text, email us if you have any questions, and we'll get back to you. But again, thanks so much. We really appreciate you all. We will see you on the next edition of The Closing Bell. Have a good one.
Okay. God bless.